Hello everybody, welcome to another episode of Erickson TV. Curtis here with Lauren. Hey Lauren.
Hey everybody.
Hey Lauren, since we're getting close to the year end for 2011, I thought it would be interesting to talk about some tax planning strategies.
Right.
With all what's been going on with the investment markets and the volatility of the stock market and people potentially selling their investments and creating losses, and also then what's going on with this La Nina and all the weather we've been having, and, nationally we've been having floods and cold weather, cracked pipes, all kinds of strange things. I thought it'd be interesting also to talk about casualty losses, because these are some of the number one questions that I get from clients as the year end comes around. That should I be selling my investments to create a tax loss, and/or I just had a fire, or I just had a flood. Do I get a tax loss for that?
Right, and we just had a casualty loss.
Yes.
Our business got flooded, which was kind of a surprise. It's bright and sunny outside, and I come to work, and the office has been flooded. I don't quite know how that occurred, but a pipe broke and flooded the office. So obviously we had some sort of losses. The insurance company should have reimbursed some of them, but how does all that work?
Yes. Well, so for casualty losses, and you have to first of all identify if it's a personal loss versus a business loss. Okay. So for our clients that have, let's say, from their residence or a personal vehicle, they get in a car accident, perhaps they've had a theft or a break-in. First of all, you have to look at the casualty loss net of insurance proceeds. Okay, so that's number one. And then you have to do a disallowance based on 10% of your family's adjusted gross income. So in a scenario where let's say you had a car accident and you get reimbursed, but you still have, let's say, $1,000 loss after insurance reimbursement. You have to look at your adjusted gross income. So let's say you made $50,000. 10% of that is $5,000. The first $5,000 is disallowed.
So you don't get a loss. Okay.
Now, if it's a business asset, let's say it was a business car, or like our situation where it's a business location and there's floods. We still have to take away the insurance reimbursement, but we don't have to worry about that 10% disallowance. So that's a good rule for businesses. So strategically wise, if you're going to have a loss, it'd be great if it was a business asset. The last thing I wanted to say about casualty losses, though, is you also have to look at your basis. And so what that means is if it is a business asset, and for instance, on this carpet, we lost the carpet. If it was fully depreciated, we have zero basis left in that cost.
So there's no loss.
No loss. But also, if I got an insurance reimbursement, I could potentially have a gain. Of income. So something to think about there. And then let's talk about investment losses with what's been going on with the stock market. What are you hearing from your clients?
Well, people oftentimes want to know about tax loss harvesting, which is an idea that I think, at least in theory, it may make sense, and I think sometimes it probably does make sense. But there are a few little kind of hang-ups with it. If you want to tax loss harvest, generally what you're trying to do is you've got these losses and you want to match them up against gains to offset current gains or gains in the future. And so a lot of times people will try to tax loss harvest by selling after a loss, but see, there's a problem. In order to get the tax loss harvesting, you have to stay out of the market for 30 days, or else you have to sell something and then buy something different. Because if you sell something and then you buy the same thing within 30 days, you don't get a loss. That's just a wash sale. And there are very specific reasons why that happens. Well, there's a little bit of a problem. In the last month, the stock market went up 10%. So if you had tried to build in some losses in order to offset future gains, well, you missed some of the gains that you were going to try to offset. You missed 10% of them. So tax loss harvesting can be kind of a tough thing, and we don't really recommend it usually.
No, we believe in tax efficient investing, but the other thing I notice is if you look at not our clients, but nationally, there's been mass liquidations out of the equity funds all the way up through now even. And so with that, and I heard some people have justified that, saying, well, I'll go ahead and just take the tax losses on those, and the problem is there's a limit on losses if you don't have gains. And right now it's $3,000 per person or per married filing jointly. And the bad news is you can't take those losses and go backwards. You only can carry them forward. So that's a double whammy. So tax loss harvesting, from our viewpoint, can be potentially a greater trap than the benefit of doing it.
Right.
Well, thank you for watching this episode of Erickson TV, and we'll see you next time.
See you next time.